I think, key to the equity market is more on the longer end of the bond spectrum. You've seen this pretty tight inverse relationship between the 10-year yield and the U.S. equity market. And the really acute inverse correlation dates back to the middle part of last year when you saw the big move up in the 10-year yield from sub 4% to 5% from late July to late October. And that led to during the exact same period of time, a 10% correction in the S&P, 12% in the NASDAQ. And then, of course, yields started to move down. And the early part of that move down, it was to the benefit of equal weight. It was to the benefit of small caps. And then when you saw the yield move up from 3.8 to more recently 4.7, the first part of that was largely to the detriment of smaller cap stocks of equal weight, sort of down the spectrum. But then when you got up to the 4.7, it obviously caused some trouble for the market more broadly. Now I think we're back in that more nuanced part of the cycle where moves up and down in yields is likely to have more of a direct impact down the cap spectrum, where you have the zombie companies, the companies that are more at the mercy of what happens with yields. You've been reporting on it a lot this morning. Many of the larger companies earn more interest on their cash than they pay interest on debt. So I still think that the bond market is in large part in the driver's seat for the equity market, even more so than this parlor game of when's the Fed going to cut rates, when's the first meeting, and how quickly and how many.
Lizanne, we're, I guess, about 80% away through the earnings for the S&P 500
Yep.
here. Any takeaways for you one way or the other?
Yeah, so the beat rate on earnings is above the long-term average, but below the average over the last 4 quarters, although the percent by which companies have beaten is decent. But it's the top line number where the beat rate has been well below long-term and shorter term. So I think the real key is the companies that have been beating on the bottom line, particularly if they haven't beaten on the top line, it's largely because of cost-cutting methods in order to protect margins. So I think that's part of the underlying story. But we are looking at about a 10% growth rate, and that excludes the big one-time charge for Bristol-Myers Squibb. It would be 2 or 3 percentage points lower than that. But since that's one company, one time in nature, I'm using more the 10% number. But we're not seeing much movement in terms of extrapolating that better than expected first quarter into the latter part of the year. So I still think the outlooks are important. And then, as has been the case in recent quarters, stocks of companies that have missed earnings are getting disproportionately hurt relative to the reward accrued to companies outperforming expectations. So it just tells you that the market's in a little bit of a skittish state.
Yeah, I mean, sometimes those drops, like I'm on the closing bell and we report earnings, and man, sometimes that punishment is an understatement. So if we like a little bit T-bill and chill, I've been trying to come up with something really clever and it's not happening. But like large and lush, like is it large caps and bust? Like is that where you have to just
I think it's,
focus?
I think where the factor focus needs to be in things like interest cover, strength of balance sheet, strong free cash flow to enterprise value, high return on equity, does tend to generally correlate up the cap spectrum, but that doesn't mean that there aren't opportunities outside of those mega cap areas. And that's why we continue to think you want to have that factor orientation around some of those characteristics that I just mentioned. I think what you really want to avoid is the ultra low quality zombie company, not profitable segment within indexes like the Russell 2000.